How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So this is the 20th installment of the crypto series. So if everybody remembers, in last week's crypto episode, I started to talk about the Treasury report that was put out on stablecoin. And so I wanted to continue that conversation. They put together kind of like a PowerPoint presentation on the stablecoin market and how they thought, the legislation that was being proposed, i.e. the Genius Act, which unfortunately last week we saw, didn't make it across the finish line. It may yet still, but for right now, it's kind of shelved, and they're going to try to work through some of the finer, I guess, points there before bringing it back around for hopefully another vote. But what I wanted to show you guys was a couple things today, and we're gonna jump in. So I wanted to show you guys the Treasury's presentation, which we're going to get to in a second. But this was the Treasury report, and what's interesting is I'm kind of doing this episode, and you guys will see the episode that comes out tomorrow. It's almost like a two-parter, because this Treasury report is what I'm going to go through in detail in tomorrow's episode, and I'm going to show you guys some very interesting overall, some very different charts that are going to go along with this report. But the only thing in here I wanted to focus on for this crypto episode today was these two paragraphs here on stablecoins. So basically what it says here is the second charge focused on stablecoins and their intersection with the U.S. Treasury market. The current market cap of stablecoins is around $234 billion, with roughly half of that currently reported as invested in T-bills, with another $90 billion in money market funds. The committee noted that evolving market dynamics and proposed legislation have caused some estimates of the growth trajectory of stablecoins to reach $2 trillion in market cap by 2028. The committee discussed the potential impact to U.S. Treasury demand. Legislation design is likely to determine both scale and growth in the industry and sources of inflows, i.e. unbanked users, reallocations from money market funds, or reallocations from bank deposits. Growth in stablecoins from unbanked market segments would be positive for T-bill demand, while growth at the expense of money market funds would likely be neutral. Committee members worry that growth at the expense of bank deposits could impact credit creation and the existing demand profile for U.S. Treasury securities from the banking sector. Additionally, the question of interest-bearing stablecoins warrants careful consideration. Current draft legislation precludes stablecoins from paying interest. The committee expressed concerns about interest-bearing stablecoins and felt that further study was warranted, as was further regulatory environment design. So, yes, some very concerning things here, particularly as it relates to bank deposits. In other words, the stablecoin market could see this massive growth up to $2 trillion, but it could come at the expense of bank deposits. And as we all know, bank deposits are the lifeblood of every bank. You need deposits in order to be able to lend money. So that credit creation within the overall economy, that could be turned into a big issue. So here is the presentation itself, and I will blow this up a little bit. So this was called Digital Money, and this was the TBAC presentation. TBAC, I always have to look at this, stands for Treasury Borrowing Advisory Committee. That's what TBAC stands for. So the charge here says, with the growth of the cryptocurrency and digital asset economy has come the expansion of the stablecoin market in the United States and abroad. As this asset class continues to grow, the distinctions between money funds and payment stablecoins has continued to converge. Some stablecoins are moving towards paying interest. Money market funds are exploring tokenization, and Congress is considering explicitly defining what constitutes a collateralized dollar-backed payment stablecoin. Please articulate the terminal effects of interest-bearing stablecoins from a perspective of Treasury demand, U.S. dollar hegemony, the expansion of dollar-backed payment stablecoins, and potential effects for insured depository institutions. Further, do tokenized money funds present a risk should they be allowed to compete with other payment or settlement instruments? I think the short answer to that would be yes. Yes, they would. Now, before we get into this, I just wanted to show you guys this. So this was the article from Zero Hedge that I had reported on last week. So basically, stablecoins on track for 2 trillion market cap by 2028, U.S. Treasury. And what this article did was it went back to this. It reported on these couple paragraphs from the Treasury report, and then it looked at this presentation. So if you want kind of a shorter synopsis, if you will, of these two things, you could just go and check out this article from Zero Hedge, which I did put a link to this below. So I put a link to the Treasury report, the presentation, and the Zero Hedge article are all in the description down below. So, but let's take a look here. Now, I do want to apologize beforehand because these slides, I can't go through all of them in detail. It would take too long. And they are very busy. These are very, very busy slides. I would never, if I was ever putting a presentation together, I would never put something together this busy because they're very hard to follow, very hard to understand, and even somewhat hard to see. But I just wanted to try to highlight some of the, let's just hit some of the highlights here if we can. So, stablecoin market overview. So stablecoins currently have a market cap of 234 billion, are ubiquitously utilized as cash on chain, effectively serving a new payment mechanism. An emergence in tokenized MFS, money market funds, has recently created an alternative option to stablecoins, primarily given their yield-bearing feature. Evolving market dynamics has the potential to accelerate stablecoins' trajectory to reach 2 trillion in market cap by 2028. And then it goes to the second point, U.S. regulatory and dollar dynamics. So USD peg stablecoins dominate the stablecoin market. So 99% in market cap, driving near-term focus on potential legislation. We'll get we'll go through it. It breaks that down in another slide here that we'll go through in a minute. Within current proposed legislation, the Genius Act, there are several factors that are still being determined, which influences the pace at which demand may grow. Therefore, stablecoins could catalyze structural changes across the following areas, the extent of which is likely contingent on the ultimate requirements of U.S. regulated stablecoins and the corresponding growth of the stablecoin market in response. So we have, what are the potential impacts on bank deposits? What are the potential consequences for the Treasury market? What are the potential implications on monetary supply? And then finally, number 6, how could this potentially affect existing market structures? So let's go back to number 3 for a second on bank deposits. So the potential impact on bank deposits may depend on whether stablecoins are yield bearing or if they offer other operational payment features relative to the yield and functionality offered by other products. In light of potentially exacerbated competition, banks may be required to increase interest rates to maintain funding or find alternative funding sources, i.e. expand their wholesale funding activities. Or they may offer their own version of stablecoins. That could be another thing. What are the potential consequences for the Treasury market? So 2 main potential impacts of deposits moving to stablecoin. 1, an overall increase in demand for treasuries. And then 2, an overall shift to the front end of the curve. Legislation would require stablecoin issuers to hold 93D T-bills, driving a concentration of treasuries holding to the front end. So that could be an issue. Monetary supply. Demand in stablecoins could have a net neutral impact on the U.S. economy supply. However, the attractiveness of USD peg stablecoins could drive currently non-USD liquidity holdings into USD. What about potentially affecting the existing market structures? The inability for stablecoin issuers to access the Fed has the potential to exacerbate periods of stress or volatility. Yes, that could be an issue. And then, okay, so let's get down the conceptual spectrum of stablecoin impacts, potential regulatory oversight, stablecoin versatility, demands for USTs. There is a wide spectrum of digital money implementations. So you have, private sector issued, tokenized deposits, private sector issued, but then it gets into central bank. And then here's what bothers me, and we'll see this in a minute. So we have obviously cryptocurrencies, tokenized deposits, JP Morgan, Citibank, tokenized money market funds, BlackRock, Franklin Templeton, stable coins, major issuers, cryptocurrencies, trigger solutions, and then CBDC, central bank digital currency. Yeah, I've got a big issue with that. That to me is in my mind that's a non-starter. That's a big no-no. But you still have a lot, basically they're trying to pass a bill right now, which would prevent the Federal Reserve from being able to issue a central bank digital currency. Yet you have 134 countries out there that are basically still working on a central bank digital currency. So, so that's an issue. And then it says, current state of the stablecoin market. And then again, here you see the market cap currently at 234 billion. So now this is interesting. So remember it said that 99% of the market was made up in US dollars. So basically you have two big players here. You have Tether, which is the largest stable coin, and then you have Circle. So basically now Tether is made of cash and cash equivalents and precious metals. They have $145 billion market cap, whereas Circle has US repo and US treasuries, and they have just cash, US dollars, and they have a $60 billion market cap. So very interesting between, remember those names, Tether and Circle, the two biggest. Tether is USDT and Circle is USDC. Obviously T for Tether, C for Circle. But remember those two names because those are the two big players in this space right now. Rapid growth in digital money market funds has catalyzed an alternative stablecoin narrative despite obvious differences. So I'm not going to spend a lot of time on that. What the art of possible stablecoin use cases could look like for financial institutions. So it could instantaneous settlements with precision to the nearest minute, single set of rails for multiple currencies or the same rails securities are issued on, programmable payments, extended cutoff times, leading to a wide cross-section of commercial and international optimization use cases. So obviously you have issuing a stablecoin, settle on-chain digital securities transactions, managing stablecoin reserves, enhanced treasury and collateral management, cross-border payments and cross-currency swaps, trading versus stablecoin reserves, and then serve as a banking partner for stablecoin providers and managing reserves. So very interesting. Stablecoins could witness exponential growth in response to market and regulatory breakthroughs. It can, but we'll see. USD stablecoins dominate the market, driving a near-term focus on potential legislative frameworks. Yes, like we said, Tether and Circle. What are the potential impacts of stablecoin growth on bank deposits? So again, here, this is, total U.S. deposits as of the fourth quarter of 2024 in trillions. So you got 8.3 trillion in non-transactional savings, money, money market accounts, then non-transactional time deposits, 2.9 trillion. Then we have the transactional, the DDA, checking accounts, 5.7 trillion. And then transactional non-DDA, 0.9 trillion. So basically, you have about $20 trillion in deposits right now in the system. And basically, your checking account and your non-transactional, the other types of things that, basically that. But the checking account, that's the big thing that's at risk. And that's to me, I think that's a major issue for a lot of banks, that banks are going to have to look very, very closely at that. And then it gets into the issue of, should you have non-interest bearing stable coins or interest bearing stable coins? What effect ultimately will that have on bank deposits? What are the potential consequences of stablecoin growth on the treasury market? So, and then, like I said, and then this gets into the whole conversation about, could you become more concentrated on the short term, meaning being less than a year, 3, 6, 9 month, 12-month T-bills, so, very interesting. We could, spend a lot more time on that. What are the implications of stablecoin growth on the monetary system itself? So, short-term repos, international money market funds, long-term deposits, so again, very interesting stuff here. How could stablecoin growth potentially affect existing market structures? So then we get, again, more conversation on that. And then it gets into just what are the key takeaways. So 4 key takeaways here. Stablecoins could grow to 2 trillion by 2030 in response to continued market and regulatory breakthroughs. Number 2, the stablecoin market is primarily comprised of USD pegged stablecoins, driving near-term focus on potential U.S. regulatory frameworks and the accelerated impact legislation could have on the stablecoin growth. Number 3, stablecoins could disrupt traditional banks by drawing away deposits. However, they also present chances for banks and financial institutions to create innovative services and to benefit from the use of blockchain technology. And then finally, number 4, the ultimate design and adoption of stablecoins will drive the magnitude of impact that stablecoins have to the traditional banking system, as well as the demand for U.S. treasuries. So again, this is a huge topic at the moment. And then it does have an appendix with some very interesting things in there, like what are stablecoins and how are they used today? Jurisdictional comparison on proposed stablecoin regulations. I think this is very interesting. It basically looks at, the U.S. Genius Act, the MAS stablecoin regulatory framework from 2023, Singapore, the MiCA 2023 from the EU, and then Hong Kong stablecoins bill from 2024 in Hong Kong. So it's very interesting to look at, 4 different bills from 4 different countries, and looking at, hey, what are the differences here? And then finally, emergence of tokenized government securities. So again, some really good stuff in this presentation. I thought this presentation was great. It was very thorough. It really got to the heart of what some of the big issues were, and how this is going to impact the treasury market, banks, the financial system. What do we do in if a crisis hits and stablecoin doesn't have access to the Fed like the way like a traditional bank would in that sense. So some very interesting things here, and some very interesting things to think about. And I think we have to pay very close attention to this Genius Act legislation. We have to really focus in on what is it going to do, because whatever it does, it is going to have an impact on banks, on the financial system, on the treasury market. There could be some huge impacts here depending on the legislation and what happens. We also have to pay attention to legislation going on in other parts of the world, in the EU, in Singapore, and Hong Kong. How are they treating digital currency, stable coins, and what are their plans to do with it? But like I said, I thought this was a great presentation. Again, if you want to take a look at this, there is a link in the description down below, as well as the Treasury report, which I'll be covering in tomorrow's episode, and this short article here from Zero Hedge, basically a quick synopsis of the whole thing. But I would highly recommend everybody go take a look at this, because I think it is really fascinating. I think it's really interesting stuff. But like I said, I will wrap this up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. If you haven't seen the previous 19 episodes of the crypto series, go check that out. I think you might find a lot of really cool, interesting stuff in those episodes. So, but with that being said, I hope everyone has a great day out there, and I will see everyone again real soon. Thanks.